Hey, good evening, everyone. I'm Robert Preston, CEO, co-founder of Climb Capital, and we're going to kick this webinar off in just a minute. I'm excited to share the Campfire Fund and also particularly share about two new properties we're adding to the Campfire Fund. But we got some people continue to log in here. So first want to say thank you for being here. And of course, Merry Christmas. We're super excited about this time. And we're going to work hard for the next couple of weeks and finish this year out, but it's always a fun time here during the holidays. And so with that, love to get started here. First and foremost, we have to get, we got to go through some of the legal stuff here. So this is a webinar. I am going to talk about some financial projections. I'm going to talk about some outlooks. I will give you my opinion and best guesses. However, I am not an attorney. I am not a CPA. And I have to disclose to you that you should take all this information when needed and when suitable to your CPA and attorney and verify all of it and get their perspective on how that'll affect you. So this is the big disclaimer, not a CPA, not an attorney. Please take it and take it to yours. I wanted to start real quick as probably it's top of mind for all of us is what's happening with the market. And so, and maybe you guys are unfamiliar with RV parks, and that's great. So I want to throw out some data points here to help understand the market from 2022 Q4 from the perspective of RV parks. In general, the RV industry has been growing over the last decade on a pretty steady rate. We obviously saw some big fluctuations both up and down in 2020 for COVID, but very interesting. There's been a cultural shift from our customer perspective. And so what is a really neat fact here is millennials and Gen Z now make up more than half of all campers. Traditionally, back in the past, we'd expect most of the campers and RVers to be in the retirement age. But now actually my generation, I guess, now has surpassed the baby boomers in campers. 18% increase of the households that went camping last year. And that's a big number because it was 57 million households camped last year. And really an interesting fact for us as park owners is that third bullet point, right? 1 in 3 campers that camped at an RV park last year don't own a vehicle, which means essentially we've opened up the market for campers via RV share, rental companies, etc., to almost 50% more campers that used to. No longer do you have to own a camper or RV to go RVing. And so just some interesting data points for you guys to look at. These come from NAI and Campgrounds of America. We pulled this about 2 weeks ago, so some neat data. All right, so let's jump into what this is specifically, right? And here's the bottom line. We at Climb Capital really believe that the RV park industry is the best opportunity in real estate right now. And we also believe that we're one of the leaders in this emerging asset, both from a sponsorship component of that and an operational component. And we're here to share this opportunity with you today. So I wanted to explain why we think this is the best opportunity and why we think it's an emerging opportunity. And I'm going to do that by a very roundabout way. I'd like to go back about 200 years, back to the Industrial Revolution, where we started bringing people in masses back into cities and forming the actually concept of a city and suburbs, et cetera. And when we did that, there was a need and demand for housing. And we started to stack houses on top of each other, right? And we call that now an apartment complex, where we have a lot of housing units in a single area. And so that was, when we saw that need, a lot of apartment complexes were developed. And then now today, essentially, right, it's common day practice. It's part of our lives, right? There's mass dissemination, and now they're traded like a commodity. Well, in the 90s, we saw really the same thing with mini storage. We started to really outgrow our neighborhoods. Our HOAs did not allow campers and boats being stored there. We needed some extra space, and right, so we saw the emergence of an asset class called mini storage. And that was the innovation part of it, right? And then now we see them developed everywhere. And now we're really getting to that mass dissemination stage where you see them everywhere. They're now traded from an asset class, just like any other commodity. Well, for us, we really think RV parks are following this exact same trend. Really, RVing didn't exist until post-World War II. We have the vets coming back. We have the invention essentially of the SUV in the form of a Jeep, and then the Broncos and Rangers, and pick whatever SUV you like. We started wanting to get outside and being able to explore America and do that in a vehicle, right? And so RVing in itself really has not been around for more than about 70 to 80 years now. So we are in that development. We really feel like we're at the end of that development stage, where there are parks. There's a lot of parks, but there's a lot of them starting to be built. We're starting to see from a culture shift, as noted in those previous slides, that it's becoming widely accepted as a way of life, both living and for recreation. And we see it following the exact same path as multifamily mini storage, heading to the point where it will be now soon become, over the next 10 years, an investable asset that will become a commodity. And so part of our goal, like we said, what we're doing here is to amass as many of those as possible, operate them efficiently, and then at some point we'll trade them out as the cap rates compress. So just a quick history of why we think this is a unique asset class, but also on a predictable progression towards the other asset classes that we've seen before. Okay, so that was kind of macro level. Bringing it back down to a single asset level for a specific park, here's kind of the process and step that we walk through, right? So first and foremost, we're generally trying to buy existing cash flowing properties. They may be running inefficiently. They may have some deficiencies there, but we in general are buying operating existing companies. Next thing we're going to do in that park is come in there and add some perception upgrades generally, right? Better landscaping, clubhouses, bathroom makeovers, restroom makeovers, etc. Then simultaneously, we're also going to bring in some system optimization, right? That's a fancy word for basically we're bringing in online booking services, making sure we have a website, employing SEO, social media, landing pages for all the properties. More often than not, you'd be surprised. A lot of the parks that we buy have very little in the form of marketing, very little on the technical side. A lot of them are still taking reservations by phone, and that you can't find them on the internet. So it seems like an obvious thing, but it really adds a lot to the bottom line very quickly. And then we're going to move into what we'd call a little bit more the heavy lift, and that's the developing additional sites. A lot of the properties that we buy that are in the portfolio or are on their way into this fund have additional acreage. Most of the time that's usable. And a lot of time it's relatively cheap to expand. And because we already have the clubhouses, we already have the pools, we already have the bathhouses, most of the time those CapEx expenses go immediately to adding income to our NOI. Very little overhead on this stuff. And so once we've done that, we bring these parks up. We believe that we've added a lot of value. We have basically three options at the end of the day. One of our exit strategies is an institutional exit. What that means is, as we're bringing this fund together and we're amassing a relatively large portfolio of RV parks, it becomes an appetizing target for a larger private equity fund or a REIT to come in and buy the entirety of the portfolio. Generally, when that happens, we do see a larger price, a lower cap rate pricing for that. The second opportunity would be to simply recapitalize the entirety of the portfolio. That's a fancy word for us to say refi. And again, the same idea. Once we've amassed a relatively large portfolio of units diversified, we can come in and bring much more competitive, cheaper debt across the whole portfolio. And of course, thirdly, we always have the option to sell the assets individually, keep some, sell some, refi some, and use it there. So that's just kind of a holistic picture of how we think about this process in the fund from an individual level, all the way to the exit strategies we'd use for the entirety of the fund. Okay, so why RV parks? If you have not met us or met Klein Capital, for the last decade, we've invested into mobile home parks, we've invested into apartment complexes, and now we're into RV parks. And one of those reasons, right, we came up with this acronym is that we love the diverse customer base that now applies to RV parks, meaning both our customers can come from any demographic, right? From young to old, and also generally spreads across all all income levels, right? And so we may have customers who are retired, who have very large, expensive RVs, or we may have the younger family who have a pop-up camper, right? Ultimately, we are appealing and can serve a really wide customer base. We also believe that as we are in the midst of a small recession, or it may continue there, that we are recession ready. We still continue to be the cheapest way to vacation. Ultimately, statistically, we're 30% cheaper way to vacation. We've also seen that people still vacation during recessions, as we studied 08, 09, and the results of that were that RV parks still stayed very occupied, almost at the same rate as they did in the previous before that recession. So we really think that we're positioned well to weather the storm. And then in the worst case scenario, RV parks become an opportunity to provide low income housing, workforce housing, right? And so in our very worst case scenario, right, we can still just provide housing to people who live full time in there. From a purchase perspective, the opportunity is that this is a very fragmented industry, meaning there's not a lot of consolidated knowledge. There's not a lot of consolidated databases. Most brokers, most bankers, and even us are somewhat new to the RV industry from an investment perspective. They've been around for a long time, but not until just recently have people began to invest in them as an asset class, which means there's tons of opportunity out there. There are a lot of owners who have been owner operators for 20 or 30 years. They're getting the retirement age, and they are ready to retire, and they've not employed some of the social media packages and website packages that you would normally expect for businesses. I love the different types of ways to make money in an RV park, right? And we call that the revenue stream. So, of course, you have rent by the night, you have rent by the week, you have rent by the month. We're also bringing in tiny homes, which we rent on Airbnb. We sell firewood, ice cream, toilet paper, kayak rentals, bike rentals, right? There's 100 different ways to bring in revenue, more than just rent. And so that allows us to kind of really diversify and also push the margins across our properties. And again, we talk about exit flexibility. And so I've already touched on that on the previous slide, but there's a lot of different ways for us to exit this and to exit well here. Okay, so big picture, this is the Campfire Fund. We are raising $20 million to purchase RV parks across the Sun Belt of America. So Arizona, back east, and kind of Virginia, Tennessee, south, right? And with that, we expect to buy about 10 to 20 resorts in this fund. There are two ways to invest. There's two classes for accredited investors, B1 and B2. The B1 is an 11% preferred return. They're at the top of the capital stack. Once that 11% return is made, and then it is capped off. So 11% first, but limited upside. And then the B2 class has a 7% preferred return, and then a 60-40 split to the GP. And that's targeted 15 to 20% IRR. We can go in that in more detail later. Okay, so I just touched on the two classes here. I'll go over that one more time because this is important. The yield, or the B1 class, is 11% preferred return, and then it's capped off. And then the B2, 7% preferred return, and then it's a 60-40 split, including all equities. Okay, so there's a couple of things that makes Climb Capital a little bit different. One of them is, and probably most importantly, is the fact that we own a property management company. So we self-manage all of our assets through Altitude Property Management, which is a subsidiary of our company. Currently has about 20 employees in there. And that allows us to go in and actually run RV parks. One of the barriers to entry to a lot of other sponsors and syndicators like myself would be the fact that there currently is not a third-party property management option for RV parks. Multifamily, office, mini storage, most other asset classes, you can hire a company to come in and manage your asset. Well, that doesn't really exist for RV parks. So that presently is excluding a lot of other investors coming into this, which is good for us, right? Which it means there's less competition, prices are lower, returns are higher. And so for us, one of the big difference that we can provide to you, the investor, is the fact that we self-manage. It also provides a lot better optimization as we know day to day. We can see the trends in the market across our properties and across the seasons as well. And of course, it's just always easier to manage your own people than it is to manage someone else's. Just a quick recap on our track record. Currently sitting at about 1,100 sites. We purchased 25 deals so far. We've sold 11 of those, right? And right now we're sitting about at 50 million of assets under management. As I mentioned earlier, we are spread across the US right now. I am based in Pensacola, Florida. You can see here on the map, these are RV parks that we currently own. The ones in blue are parks we owned before the fund. The two in black, Nashville North and Arrowhead RV Park in black, those are parks that are already inside of the fund. And then we're excited to announce that we've got two new parks under contract that will be going into the fund likely in the next 90 days. And those are in green. The one's in Lake Powell, which is it's in Lake Powell Campground in Page, Arizona. And the other one is another RV park in the Nashville area called Owl's Roost. So I wanted to give you a quick summary and highlight of the two parks that are already in the fund. This is Nashville North RV Resort. We purchased this park about 5 months ago. It's 94 sites. It's just north of Nashville, 20 minutes from downtown. We actually have a shuttle that goes down to Broadway, makes a loop and brings our guests back. This is what we call a stabilized core asset. It was a KOA. We chose to drop the franchise. We chose to drop the franchise and run it underneath our own branding. And there's really not much to do here, to be honest, right? There's not much room for expansion. This one's well run. We simply increase the rates a little bit, provide some efficiencies on the expenses, particularly the KOA branding and franchise expense, and we continue to grow. So we love this because it's obviously in the path of progress in the North Nashville area, and the Nashville market is growing. Okay, so for this particular asset, if we broke it down, just this asset, what would it look like for a $250,000 investment from either class? So the B1, relatively easy calculation, it's 11%, right? So you have that throughout the year. And then of course, when we liquidate or dispose of our assets at the 5-year mark, which is the planned exit for most of these, we return that, right? So the cash on cash is obviously 11%, IRR is 11%. On the B2 side, this specific deal, you can see our projected cash flows through there. And then of course, the share and the profit at the sale for a cumulative cash on cash of about 9.4%, 2 multiple and a 17% IRR. Just want to share this if this was a single asset outside the fund. Okay, so the second park that we have in the fund right now already is called Arrowhead RV Park. It is in North Alabama, about 45 minutes north of Birmingham. It's on Smith Lake, which is a destination lake for Birmingham and Huntsville. We like this property for a different reason. This has 40 sites presently, but it came with 50 acres. We have 36 mini storage sites. This has a pool, it has a marina, this has a restaurant, there's a lot of things. But what we really love is there's basically about 40 acres of undeveloped land that you can see there, which we are in the process of getting engineered. We expect to add about another 150 sites to this property. So this one allows us to really build equity in the fund, as this will be a major development. All right, so again, looking at this deal, it's slightly different for your B1 and B2 class. Main thing being year one, on this one, we're budgeting no cash flow as we prepare for the development. And of course, we eventually we'll sell it there. So for your B1, right, year 1, year 2, however, we expect to be able to refinance this one, return both the cumulative 4 years worth of 11% preferred return, but in year 3, which boosts the cash on cash and the IRR. All right. For the B2 class, again, a little bit different here. Year 1 is basically a wash. Year 2, we should begin to build cash flow. In year 3, we have a fully developed park, and then year 4, we liquidate it. So this one's got a 3x multiple and a IRR predicted of 35.1% for this class. So you can tell as you blend these two together, you would get a blended return for the fund. Most of our target assets are more like Nashville North. We're looking for generally more stabilized there. We will use 1 or 2 properties here that have a large construction component of it to help diversify the returns a little. Okay, so here is one of our target parks that is going into the fund. This property is under contract. I've been working on trying to buy this park for almost 1.5 years now, working with the seller, and we finally came to a deal. We finally have it under contract. So I also like this because it's in the Nashville market. It is only 1 exit north of our existing property there. So we're going to be able to utilize some economies of scale with our staffing and equipment, the shuttle, et cetera, to really be able to reduce some expenses to both parks and come up. This park is run honestly, very poorly. The owner is elderly, no online booking, no website, no rentals by the night, no social media. It's just simply not well run. However, the economics are still pretty good. This park stays very full because of its location. So there's a lot of upside for this park that we like. Okay, so the next park that is in the pipeline here to be closed and put in the park, to be put in the fund is Lake Powell. Beautiful campground on Lake Powell. It's about 4 hours north of Phoenix, 2 hours, a little bit less than an hour from the Grand Canyon National Park, 3 hours from Las Vegas. It's 140 sites. It does have some glamping sites down here. You see with the with the covered wagon. It's obviously on Lake Powell, a huge resort destination with Mount Zion, National Forest, all around there. So great location, great property, well run, and honestly, we're getting it for a great price right now. We found this one off market through a text campaign. And so again, we're able to kind of bring that to you guys as an off market opportunity here. Right now, we also are negotiating with sellers for owner financing, so for some pretty favorable terms. And of course, that has a lot of benefits in today's debt market. Okay, a little bit about us. I mentioned a track record, but here's just a picture of the team. Myself up there, top left. From top to bottom, I think we are sourced with great people. Most of us are military, prior military, who have come out of that. And so I love our team. Jake Chambers down there in the middle, he is director of our property management. So he runs APM, key person out of that. And then on the bottom, you'll see we have Cliff Luber, Tess, and Doug, who are co-sponsors for Upward Capital and Honor and Equity. So happy to have them on the team. Okay, so we're going to go through a bunch of questions here in a second, but next steps. If you're interested in the fund, you want to get much more detailed information, please take out your camera, hit that QR code, schedule a meeting with myself or someone else on the team. Of course, you can always email us at info@climbcapital.com, or I'll show you my email in a second. The next step's pretty easy. Make contact, let us know you're interested. Let's schedule a one-on-one call, make sure we're a good fit for you and vice versa. From there, once we know that you qualify and are interested, we open up an investor portal. You'll create a secure login and ID that's unique to yourself. You'll be able to review all the documents there, which will be the PPM, the operating agreement, subscription agreement. And once those are complete, signed by yourself and myself, we'll request wiring funds, make the funds, and at that point, you're part of the fund and you begin accruing preferred return. I know I probably glossed over quickly, we are planning on doing quarterly returns. So we'll do monthly updates, which you'll get the P&Ls for each property and balance sheets. We do quarterly distributions. We'll make those distributions. At the end of the year, you'll get a K1, which will have depreciation on it. We are pursuing cost segregation, accelerated depreciation on most of these assets, which is a nice benefit from a tax savings purpose. And we do expect this to be a 5-year fund. So you should come into this with the expectation being committed to the fund for about 5 years. At that point, we'll begin the recapitalization process at the 5-year mark. So with that, if you have any questions, please feel free to type them in the Q&A box. I will keep this open for a little bit as you guys type in questions. And sorry, let me go to this last slide. Here we go. This is same QR code, take you to a calendar link where you can schedule a meeting. That's also my email and our office phone. So if there are no questions. Okay, so one of the questions, when do we think the first quarterly distribution will go out? Likely that'll be Q2 of 2023. So it'll be, yeah, next July, end of June, July of 2023. Thanks, Harper, for that question. Jim, you asked, what is the cost seg schedule? Yeah, I might have to ask you to explain a little bit more on that question. If you're asking when we're doing that, every property that we buy, we're scheduling that in the year that we buy it. And if you're asking like the schedule of it, typically on an RV park, we're actually getting close to 30% depreciation that year 1 and 2. So hopefully that helps answer the question there, Jim. If not, please let me know. Will the fund close opportunity for investors? If so, when? Okay, so there are 2 limitations here inside the fund. One is for the B1 class, we will only be taking 10% of the capital there, which means 2 million of that 20 million will be allowed to come in as the B1 class. Right now, we have just right at $1 million of the B1 class committed. So there's $1 million left there for the B1 class. And then timeline wise, we will close this fund out one way or the other. I think it's August 1st of 2023. So that's the limitation there. Of course, if we fill the fund, which we expect to do in the next couple of months with the deals coming in with that 20 million beforehand, then the fund will be closed off as well. Hey, so David asked a great question here. Does major weather events affect the parks? Well, of course, it does, and it depends on where. So one of the nice part about the fund, though, is we are diversified across many states and many regions. However, we've found that even here in Florida, when you have a hurricane come in, of course, it's never a good thing. But one of the most needed things post-hurricane is housing across the board. And then particularly, you have to have space for all the disaster relief. So if you're from the South, you've seen the hundreds and hundreds of pole trucks come, followed quickly with the campers and all of that stuff. And so for an RV park, honestly, this is harsh to say, but natural disasters are really generally a pretty good thing for occupancy and rates, as they are by far the quickest and easiest things to get back up and running and provide places for housing. So we're kind of diversified both across regions, and then honestly, it's not that bad to have a natural disaster. So nothing we want to deal with, but we can recover it pretty quickly. We do have insurance. We do have loss of income insurance. Most of the time, there's not much structure to cover in the insurance besides the clubhouse and a few of the outbuildings. Jim, you asked how much we raised so far. So we are a little bit above 7 million. Of the 20 million have been raised over the last couple months. We also kind of put a little bit of a pause on that for the last few months as we needed to get the deal flow of the new properties sped back up. And now that we've seen the market pick back up, things become a little bit normalized. We are now picking up the desire and need to raise capital. David, you asked, do they rent all year round? Yeah, so for us, if you look at that criteria of where we're buying it geographically, the main reason is we want to have parks that are open all year round. And so for us, that means south of the freezing line. We want to have parks that are there all year. Some areas are more seasonal, where you have vacationers in the summer or winter, depending on which region you're in. But in almost all of our parks, we have a component, typically between 30 to 60% of the park, that we rent by the month. And that's typically to long-term tenants who are traveling nurses, welders, shutdown crews, construction crews. They may be there 6 to 10 months at a time. So we always have that component in a park. So Jim asked, how many full cycle deals completed? For us, that's been 11 so far. One of those has been an RV park. So the very first RV park that we purchased was in February of 2020. It was a small one. It was our first one. We bought that basically on our own, not using the syndication or fund model, so we could learn on it. And we bought that one for $550,000, which is very cheap. And we sold that in February of 2020 this year. February of 2022 this year. So 2 years later, we sold that for just under 1.2 million. We had no CapEx in it, so it's one of the reasons we decided that this might be something good to pursue. The rest of them were apartment complexes, typically C-class, or mobile home parks. We have a lot of experience in mobile home parks. Mike asked, would you consider partnership areas not in your footprint, working on an owner in Michigan close to Chicago? So the answer is always maybe. Depends on how great the deal is. Again, if there's a park that's open all year round, that's really our main criteria, and that's largely driven by the staffing needs. We really want to get great people in the parks at a management level. And if we have to shut the park down for 3 or 4 months in the winter, they obviously have to go find different jobs. And then we have to go rehire, and that becomes a bit cumbersome. So for us, right, it's really driven by the fact of making sure that we can be open all year round so we can get the best staff possible. So Mike, yeah, please send it to me. I always want to look at deals. Do we ever evict anyone? Typically, no, we don't have to, which is a nice part of RV park. It's not necessarily landlord laws for most states, right? We're dealing with a customer retail base. And so state to state, county to county is different, but most of the time it is very quick and easy to remove someone who is either not paying or not complying with our rules and regulations. So it is honestly one of the reasons I moved to RV parks from multifamily and mobile home parks, particularly with the eviction moratorium of 2020, was the fact that I couldn't enforce that on the multifamily side. So if we have to, technically we can do an eviction process. Most of the time we ask them to leave, they do, or we use the police for trespassing for the short term. I will say most of the time it's just not a factor. Our customers pay, they want to be there. It's part of being an RV park is that you enjoy it. The short-term customers obviously pay ahead of time. And so it's just generally not a problem. Collections are not a problem in RV parks. Jim asked, do we focus on acquisition of existing parks or developing land for use? Basically, 90% of what we're doing are existing parks. Well, I'll quantify it. For this fund, 100% of the properties that go into this will be existing parks. Some of them, small 10% of them, will be like Arrowhead, where they have a large development component of it. They are existing, but they have a large component. Most of them we're buying, and we're probably adding 10 to 20% more sites. So it's a much smaller development component for that. What are the main risk factors for this deal? Well, of course, you have to consider RV parks in general, right? You have no leases per se. So there is always a chance you have the volatility of your customers leaving, your customers not showing up via gas prices, et cetera. So we think that we've mitigated a lot of this by where we buy. We buy parks that are on interstates, close to interstate exits. We buy parks in the Southeast where there's a large population density. I love Wyoming. I love vacationing out there, but there's 600,000 people in the entirety of the state. And during the summer, it's phenomenal, but I won't buy an RV park in Wyoming. There's simply not enough people in there to need them. Whereas I live in Florida, if gas prices increase, I'm not going to drive from Florida in my RV at 6 miles a gallon to go to Wyoming. However, I will go 100 miles, 200 miles down the coast to Panama City and vacation there. And so we saw this summer with gas prices increasing. We had a lot of cancellations from customers who were coming more than 750 miles. But then immediately we were rebooked by customers coming from 200 miles or less. And so what happened was, just like I said, they would cancel their trips that were long distances. They still used their RV. They still went, and they just went much shorter. And so that's why we really like to be in the Southeast, in the South in general, whether it's on the interstates to make it convenient. I think that's probably one of our higher risks. Otherwise, if the economy does well, we sell more retail. If the economy goes poor into the recession, then we just change our ratio of long-term to short-term rentals and rent more to the long-term. Jimmy asked, what's the minimum investment amount? And yes, we will be recording that. So the minimum investment amount is $50,000. Unfortunately, right now, this is for accredited investors only. So this is a 506C published with the SEC for accredited investors. Another question: what is the equity percentage on B2 for 100,000? I don't think I understand that question, but so the B2 return structure is that you have a 7% preferred return. Once that's met, and if it is not met in any given year, that is rolled forward, accrued to the next year. So once all that is met in any year, then it is split 60% to you, the investor, and then 40% back to us, client capital. Hopefully that answers your question. If not, we can do that. A lot of great questions tonight, guys. I'll leave it open for like 30 more seconds. Talk about it. If not, we'll get ready for Christmas. So please, if you're interested, this will be recorded. This will be emailed back out to you in a couple of days. But the best way to get moving here is to schedule a meeting via the email or that QR code. We'll sit down one-on-one, take 30 minutes to make sure that go into detail of any of this and make sure that we're a good fit for each other, and then we move on. Okay, thank you, everyone. I'm going to end this, and Merry Christmas, Happy New Year.